So, ladies and gentlemen, firstly, welcome again. As we spearhead a transformative journey propelling digital MSME lending into a new realm of unprecedented growth and accessibility, let us learn more about driving growth in digital MSME lending through a great panel discussion coming up. First up, I'd like to welcome our moderator, Ms. Pallavi Madhok, the Vice President, Advisory Services, South Asia, Women World Banking. Let's welcome our lady with a warm round of applause. Thank you, Pallavi. You're looking absolutely gorgeous. Thank you for joining us. Yes, ma'am, whatever you'd like. Joining Pallavi on the stage are our esteemed set of panelists. First up, Managing Director, Equifax Credit Information Services, Aditya B. Chatterjee. Welcome, Mr. Chatterjee. Co-founder and CEO, Indifi Technologies Private Limited, Mr. Alok Mittal. CEO and co-founder, Namaste Credit, Gaurav Anand. Group CFO, Vayana, Vinod Parmar. And the MD and South Asia Trade Head, Citi, Mayank Gupta. So, ladies and gentlemen, with such a great panel on the stage, Pallavi, over to you in your able hands for the curation forward.
Thanks a lot. Thank you. Hello. Welcome, everyone. I know this is the lunch hour, so I hope this group has eaten lunch. Or actually, it might just be better that you've not eaten lunch and you're nice and alert. Welcome to the panel discussion on unlocking the untapped potential of digital MSME lending. I'd like to set the context in a few minutes first. A quick look at the overall lending ecosystem in India reveals that there is ample scope for increased lending to both individuals and enterprises. Findex 2021 shows that only 12% of Indians have borrowed from a formal financial institution, and this compares relatively poorer to other markets like maybe a Thailand or a Philippines. It's actually double there. Further slicing of the data reveals that there are many customer segments that are underserved. For example, urban access to finance would be 15%, whereas obviously in rural it'll be 11%. Men would have 15% access, whereas women would have 10%. This is a very similar story when it comes to MSME lending also. It's estimated that only 10% of enterprises in India have availed formal loans. And a lot of the lenders out here would know that this is probably with a CIBIL score of maybe 700. They have existing business and credit histories, so on and so forth. So just a top 10% of our market is currently being served. The lending ecosystem has to work for not just these few select customers and enterprises. It has to work for a larger customer base who might have slightly lower credit scores, a customer base who are otherwise ignored or rejected due to lack of data, a customer base which can finally be accessed because of digital technologies. So, at the outset, we all know a lot about what digital lending can do, so I'm not going to talk about that. The burning question today is, how can lenders use digital technologies and leverage the technologies to viably tap the 90% of India that still does not have access to formal lending? So I'm hoping to explore some solutions here with a very dynamic group of forward-thinking financial service providers. We have Aditya from Equifax, Alok from Indifi, Gaurav from Namaste Credit, Vinod from Vayana, and Mayank from Citi. So thank you all for joining the panel today. And without further ado, I'm going to jump straight into some questions. I'm actually going to direct my first question to you, Mayank. How do you see, or rather, what are some of the key enablers in the Indian digital landscape that you feel will significantly address this gap, the credit gap for MSME lending?
Thank you for that, Pallavi. Let me sort of take a step back before I respond to your question more directly. Why is lending to MSMEs so critical? MSMEs are critical for the social economic development of the country. Just some more statistics to further make it interesting. A third of India's GDP is contributed by MSMEs themselves. 40% of India's exports come from MSMEs. 11 crore jobs are generated by MSMEs. So clearly, they are not just the backbone, but the hands and legs of the Indian economy. And if Indian economy really has to, succeed, we need to do all that we can to enable these MSMEs to succeed. One of the main enablers is the ability for them to access credit. Now, let's really think about why can't they access credit, given we have a plethora of financial institutions, we have a plethora of non-banking financial companies covering the length and breadth of the country. Why are they not able to access it? I would probably say that, there are two ways, two core reasons, right? These MSMEs don't have access to collateral, something that most financial institutions have looked for as they make lending decisions. And these financial institutions don't have the financial papers or the financial statements that give classical underwriters the comfort to be able to lend credit. And there was an economic report published which said that this funding gap is now as large as $300 billion. $300 billion of funding that will help India truly achieve its potential of double-digit economic growth. And that is where the crux of the problem is, Pallavi, that the traditional means of underwriting are not suitable to underwrite this bottom 90% of MSMEs. And that's where I believe that the government, the private enterprise, the private capital, the financial institutions have taken a massive leap forward through the fourth layer in the Jan-Dhan stack, which is the consent layer, which is providing data that can be used by lenders to make real-time decisions. And I think that's really the biggest step forward in solving this problem.
That's a lovely segue for me to move actually to you, Alok, because you as a practitioner are actually currently serving the missing middle today. So from your experience, what are you doing? And what should other NBFCs learn from you on how to leverage some of these upcoming digital platforms?
Yeah, I think I agree on the statement of the problem, right? There's a lot of inefficiency in this chain, both with regards to operating cost, the credit decisioning capability, and then the financing structures and hence the cost of funds. The approach that we've taken really is to stitch partnerships that allow us to solve for each of these issues, right? So about 80% of our business on the front end, origination, comes in partnership with platforms that actually already have access to customers. Right? So think about sellers on an Amazon platform, think about merchants acquired by GPay, right? And so on and so forth. And what that does is it makes credit available in a more seamless fashion, but at the same time reduces the cost of origination on the front end, right? This contrasts to the notion of every bank or financial services company trying to establish its own branch infrastructure and incurring that cost. The second piece of credit decisioning is addressed through data-driven models. That is the in-house capability that we are developing. And again, since data is only coming upstream, 10 years back, data wasn't available easily. I think these models are beginning to provide better discrimination in risk compared to what underwriters can, right? And there are, small examples, right? In the industry, there's almost a belief that 3-year vintage suddenly makes an MSME creditworthy, right? Now we have tested data, and it does not, right? And I could go, on and on this one, but the way the industry has evolved due to lack of data and analytics capability is that these relatively fixed policies started to permeate the industry, and I think this is a point at which I think all financial institutions are challenging that. Right? Yeah. The third piece that we are addressing is the inefficiency in the funds flow. Right? So today, large bank will lend to a large NBFC, will lend to a small NBFC, will lend to the borrower. At every layer of this stack, there is equity which is provisioned against the funds being deployed. And what that means is by the time you traverse the stack, 50% of the funds are coming through equity at some layer. And that makes that structure very, very inefficient. Cost of funding goes up, and hence the cost of borrowing for the MSME goes up. Now, here again, we have created a marketplace, and the regulator has supported this through mechanisms like co-lending, where money can now directly flow, from bank to the end borrower without having to traverse different balance sheets. In fact, the next leap of faith there is peer-to-peer, right? What the regulator is saying is maybe the bank is an unnecessary intermediary in the flow of funds, right? So why bother them, right? Let's just develop a direct bridge.
Correct.
So I think these are the core elements that we are leveraging. The big theme for us is partnerships to be able to solve each of these challenges and hence make credit more accessible and affordable.
Yeah. So you said quite a few things. I'm going to pick on the piece on data and how data is actually now enabling very different kind of credit policies maybe. So Gaurav, I wanted to direct the question to you. Do you see this actually happening? Is data an enabler? Are banks changing? A lot of the existing banks and NBFCs, many of them are here in the audience. Are they changing any of their ways of underwriting?
Let me give you a very interesting anecdote. A restaurant chain, right, with one franchise in the heart of a city and a similar franchise in the 150 kilometers away from the city. Both applied for a working capital. The one in the former one, which is in the heart of a city, gets accessed by banks, gets lending for working capital at 12% ROI. Fairly 3 to 4 weeks of time frame it takes them to get the funding. The poor guy, just 150 kilometers away from the city, gets rejected by almost all the banks. Eventually, NBFCs come forward and lend him at 22%, right? Financially, they're very sound. Both are very similar. And and this example, why I'm quoting it, is kind of underscores the playing field for banks and NBFCs, right? Banks have more selection bias, but they can give you best affordability.
Yes.
They can give you larger tickets, right? But their own OpEx model, like even Alok mentioned, doesn't allow them to lend small ticket.
Correct.
On the other hand, NBFCs, if you look at it, they have a lending rate bias, right? They can give access, but they're going to charge you arms and legs. And because their own OpEx structure is such. If you unpeel the onion in reality, right, you will see the crux is the lack of ability to underwrite SMEs holistically, intelligently, right? Otherwise, there is no reason why there should be so much disparity for a similar business types,
Correct.
right? And that's where I think India is on a very interesting path, and I think we are one of the can say forefront enablers by bringing deep tech, not just tech. This is a problem which can be solved through deep tech and data science. Now let's quickly look at how deep tech and data science can truly solve for an underwriting problem for small businesses.
And also mention if banks are actually using this, because otherwise it's, like everyone says, hum karte hain, but actually koi karta nahi.
Because they are in a comfort zone, right? Despite limited tech adoption, banks are still gaining market share. I mean, there is little push for them to adopt technology at a faster clip. NBFCs are forced to adopt because you have to work on your OpEx. We can't charge 22% and continue to hold a very high quality portfolio. You have to reduce your OpEx.
Correct.
So coming back to the play of tech here, tech and data is going to play 3 very significant roles here, more and more so, and across the board. First being ability to read, access unstructured data. Ability to get access to data which SME is still not providing, and banks are not accessing it.
Yes.
How do you, and this is a very acute problem in a country where still 50 million small businesses are new to credit. You don't even have a support of a bureau to look up their background. Tech can really play a significant role in accessing the data, which has very high correlation to the customer's intent and ability. Second component of tech, the way it's going to play, and again, I think we are pushing it the envelope here, how can you detect fraud upfront? No underwriting is completed without the conscious understanding of a risk and a fraud, which is very prevalent. And that's this factor of being unknown actually causes more inertia in the bank's mind to expand, right? And the third very important point is that how do you assess an SME? 99% of credit decisions in India are taken on a single variable, which is profit after tax. Tell me what an SME which really reports a true PAT. It's a corporate lending model. It doesn't fit SME world. So I think these are I would say, very pronounced, profound impact both data and deep tech is creating and going to actually steamroll the change much faster to create a much more level playing field. India can ill afford this kind of a lopsided credit offtake. On one hand, you have a customer who's being killed for affordability. On the other hand, the customer doesn't get access. So I think this is we are in a very interesting spot. And I think this is just going to become more and more prevalent and profound.
I hope so. I'm sure people, so a lot of good things, but I want to definitely move on to the next question. This is actually to Aditya. It's a very, now we're moving to I wanted to ask you about microfinance institutions who've been very successfully serving the bottom of the pyramid. So they don't have a lot of what Indifi or Gaurav's deep tech has. In fact, their model is very different. It's hyperlocal, high touch, but they too have struggled with actually moving beyond consumption loans. So do you think digital technology is useful for them too, because they're also very important and they already have access and reach to the customers that we're speaking about?
Right. Thanks, Pallavi. So the first point, we need to understand that MSME is not a homogeneous group. The first M, the S, and the second M are vastly separate cohorts.
Yes.
As a bureau, we take a few bets, and the one bet we have taken is on the micro, right? And that bet is through our MFI play. What we have seen is that more and more these MFI loans are actually taken for working capital or BL, right? It has moved past the consumption to be used as a working capital loan or a small ticket business loan. In fact, we did a survey, and the fastest loan growth is business loans in tier 3 cities, which is growing at excess of 35%. That's the extent of the loan growth that we are seeing, right? And also, in the MFI space, we are seeing that there is, we use the term graduation, a graduation of an individual from an MFI environment to a retail environment. In some use cases, this graduation is as much, this overlap, if you want to call it, is as much as 30%. So from the joint liability groups, they are going up and taking the loans individually. Lastly, coming on your point of digitalization, an interesting story, I was with a risk head of a MFI in Calcutta, and with a huge amount of pride in his voice, he said, Aditya, today 1% of our loans are truly digital. Now, do stress on that 1%, think about it. MFI, which is such a high touch, which is such high personalization, today 1% of that loan is purely digital, and he said that their target is to make it about 25% in 3 years, and let's see where that goes. But I think that needle on digital is moving, and digital has affected everything. It's just a matter of time that MFI also envelops it. So.
Yeah, no, thank you for that, because otherwise we think digital lending is only typically happening with MFIs or with fintechs, etc. So I appreciate that input. Vinod, I'd like to move to you now. I understand your focus is on providing affordable loans and to MSMEs, and it's a very different business model. So can you throw some light on your model?
So I think all four have essentially highlighted a couple of points, and I'll just like to further build on that. Firstly, point Aditya made, MSME actually has a wide variety or a spectrum of businesses and borrowers we are talking about. So the same approach is not going to work for all of them. Second, India in general, I think like people are discovering in e-commerce and many other businesses, we are a shallow market when it comes to certain quality and size thresholds today that the entire financial ecosystem is used to. Every service you talk about, you essentially will have A-grade service for a certain set of borrowers or customers, and then you sort of see reach, access, affordability sort of falling down as you go down the layers. Some number crunching, our team had done in the office some time back, and very simple formula we look at in terms of slicing the market. 700 odd companies above $1 billion in size, 7,000 odd above $100 million in size in terms of their declared turnovers, about 70,000 odd, about 10 million in size, and then you've got this huge, long list, which sort of goes all the way up to the 63 or 70 million micro SMEs, depending on what number you choose. So it's probably up to the first 700 odd thousand borrowers where access to credit, access to some form of rating, either external or within a bank's framework is possible.
Correct.
And that's the segment that everybody is comfortable lending, either secured or unsecured. Moment you go below that is really where the shallowness really starts becoming deep. So when people talk about a corporate or an enterprise pyramid, in our language, it's not a pyramid, it's a spire. Like a very thin top and a very, very fat sort of base at the bottom. Which means fundamentally we need to look at very different ways to engage that large fat bottom, right? Very different ways to assess. So when we were sort of thinking about our own approach to the space, we had two choices long back when we started our journey. Should we also become a balance sheet player and look at, picking up certain segments of these markets, right? And start focusing either clusters, sectors, or size. Or should we become a platform which can start with one layer and walk down the journey up to the last mile? So essentially, supply chain finance or trade, we believe strongly, is one way to sort of go down that path. Because I think there are some inherent advantages. I think Aditya made this, very important point. That working capital is really the larger need for most small businesses.
Yes.
Dukaan chalane ke liye is already invested.
Correct.
If he's got some small workshop, he's probably already put a lathe machine or a turning machine.
Correct.
Where he gets stuck is that 10 lakh odd crore MSME receivables that everybody likes to talk about, and there are some solutions coming up. I think we've probably not solved 90% of that market even today. So our goal was very clear. Look at a structured way in which you can start at the top and keep getting good quality referral introductions all the way down. Second, create a model where you're running purpose-driven credit, which is really what supply chain finance or trade finance is all about. You're essentially funding the working capital on the business, not an open line where you could just, COVID happened and you had a medical emergency, the money moved there. You had an event in the family, money moved there. I think that's not obviously a cycle that they will ever be able to control unless you tell them this money is for this purpose of buying or selling, right? The third part, of course, is how do you look at assessing them? And that's where I think all the changes that India has seen over the last 5-6 years, I think it has probably set ourselves on a great path going forward. Today, there are two types of data sources that we end up using, and in fact, we also assist, obviously, our banks and FIs on that line. You've got public data through a lot of sources, which is, in fact, available even without consent, and you've got consent-driven data. And if you add both of this, you would never want to go and look at the financials. So to Gaurav's point about, people being used to a PAT-based model,
Correct.
you actually don't need to look at the financials of an SME as long as you have transactional data, which you get through GST, ledger statements, bank statement, and a lot of other public data. So that's, I think, to us, probably a great way to address the final point that I would just like to sort of make right now is affordability. I think people often talk about MSMEs in terms of access, and yes, there is a challenge, like I said, for the last mile. But I think people still find their way somehow to survive by borrowing, maybe through informal or other forms of expensive capital. Even in the NBFC space, there are people lending starting 10, 11, 12%, all the way up to 36% to businesses, right? I think there is no business in the SME space who can survive at any cost which is upwards of 1.5% a month in the long run. Because the margins don't, sort of support that. They're all a net 3-4% margin business. 2% agar ब्याज में जाना हर महीना is unlikely to be able to survive beyond the point. So is cycle to cycle, month to month, right? So that's something I think collectively a lot of us can sort of address.
No, but how are you managing to provide affordable credit?
So two things. One, obviously, it's also got to be about economics for the bank partners that we work with, the NBFC partners we work with. So we're very clear, like I said, that we won't go down the balance sheet path, not for a long time, because cost of funds is probably the starting point at which you decide at what rate you will lend. So if my cost of funds is 12 or 13 or 14, I'm not going to be in a position to lend anything less than 20. So we said, let's address that first. And the first thing we did was went and partnered with some of the largest banks in the country who got on an average cost of funds in the 5, 6, 7% range, which means lending at 8, 9, 10, 11, 12 is a thought. Yes. Second, we always were very clear we'll use a lot of data in helping assess those SMEs because we were not keen on building a huge feet on street because that's not a very scalable model. Banks, NBFCs by design will have branch-led models. If fintech start following the same and create armies of 1,000, 2,000 people on street, I don't think there's a right path that we should go with. And lastly, of course, was purpose-driven credit. So in short tenor, whether it's 15 days or 90 days or 120 days, you can price them well because they'll keep coming back to you every single time.
Yeah. Mayank, I wanted to, a related question. As an institutional bank, you already serve a lot of conglomerates, FMCG companies, etc., who have such supply chains. Do they find supply chain financing valuable to them? Do you find it valuable as an institutional bank?
Sure.
And also, how can we really scale this up for impact at scale?
Fantastic question. Honestly, COVID changed a lot of things, right? Supply chain being a back office conversation suddenly moved to very front and center of the boards. Supply chain resiliency, the ability to ensure smooth supply of goods became a business enabler, became a business imperative almost. So suddenly we had, now with the sale of our consumer bank, Citi focuses on the institutional side of banking. But our institutions, our large conglomerates and corporate clients were approaching us on how can we help them build supply chain resiliency. And one of the ways, of course, is the whole supply chain finance that we spoke of. But there's also a bigger need for us to go up and down the value chain and start to finance the suppliers, the deep tier suppliers, likewise the distributors and the dealers for the flows related to the anchor. And let me take an example. Let's take Unilever as a case in point, right? Now, Unilever suppliers will get access to credit using supply chain finance after they deliver goods to Unilever. That's pretty par for the course solution, has been in existence for a while. But when does the Unilever supplier really need money? He needs money at the time a purchase order has been issued by Unilever. At that point, he then goes ahead and places an order to his supplier to buy goods. And that's when the credit need starts to emerge. So as you think about that credit need, we've realized that 70% of that credit need from that single purchase order hasn't been tapped. And because Unilever banks with us and we've seen their flows for years on end, we have a very intuitive understanding of what is the performance of the supplier, what is the performance of the supplier, what rating does Unilever attach to the supplier, and so on and so forth. And we're now starting to use the data that all of these gentlemen have spoken of and sort of conflicting that data with this proprietary data of transactional history and starting to make decisions on lending to these suppliers and to their suppliers and truly starting to add value.
So you'll be competing with Vayana shortly.
No, I'll be using Vayana.
No computing.
No competing.
But yeah, I think on both sides of the value chain, the ability to use the data, the ability to underwrite quickly, and the ability, I mean, we used to underwrite once a year in the old model, the pad-driven model. Now you have the ability to underwrite every day.
Yeah, that's another one I think we chatted about, and I'm going to come to you later, but please do.
Yeah, sorry, I didn't mean to.
No.
But yeah, the ability to, and I think BCG in a report said that underwriting using alternate data is 40% safer than underwriting using a dated PAT model. So a lot to look forward to, a lot of opportunity to grow. I would think that a lot of private capital is going to chase this opportunity if it's not already starting.
Yeah. And I remember, Vinod, just to conclude, you told me that the market is so huge that there could be, I think, 100 players and it will still not satisfy this market.
Absolutely. So if you look at sort of the B2B trade, right, on a monthly basis, you probably are seeing about 110 to about 120 billion odd in trade across, let's say up to the last mile on the MSME side. And today, all sorts of formal solutions on working capital, your traditional collateral-driven cash credit, some form of supply chain, obviously, that India is already seeing build up, all put together addresses about 40-45 billion, all formal sources put together, which means there's still another 50-55% which is being managed within the ecosystem. So I think one of the first things we realized and sort of shattered our own myths is that there is always this unsolved problem. It is solved, but it's solved probably in a crude way. It's solved through the trade. So the distributor offering goods on credit to the dealer offering goods on credit to the retailer. Likewise, the supplier example that Mayank spoke about. I think the question is, what all collectively can we, right, all the folks sitting in this room can do to make that more accessible and more affordable? So today, in between the distributor dealer, they probably are pricing in a 18% or a 20% or a 30% model. Can we collectively find solutions where we can bring that cost down to 15 or lower?
Correct.
At that rate, you probably are pushing these people into a formal ecosystem. You're also getting them used to high quality credit if their behavior is good in the long term. And I think that's, just to talk about one number before I end, in about 20 odd billion that we have managed to facilitate so far on the platform, banks have not lost a rupee. And that's precisely because the borrowers have realized this is probably the cheapest cost of unsecured, predictable money or cash flow they can ever have access to. They will ensure umbilical cord never gets cut. So whether it was COVID or otherwise, they were all good.
Right.
So, in the industry parlance, 30 days past due is one way to sort of judge the quality of the portfolio. The highest we ever saw was 5% in the peak of COVID. I think inherently we need to sort of cut down some of the biases like, we've all spoken. They're all good businesses. They just probably need some avenues to get affordable credit.
Right. No, thank you for that. Okay, before I come to Gaurav, because I do have a lot of questions for you, Gaurav, but Alok, you mentioned data, and I wanted to understand from you that Are you leveraging AI, data, deep tech, and able to address some segments which were otherwise not being served?
Yeah. So Pallavi, our reason for existence is to serve segments that are not served, right? So just by reference, about 40% of our customers have never taken a business loan before.
Okay.
Any form of business loan, right? Now, as we do that, we use all of the techniques that you mentioned, but at the same time, we use a fair bit of human insights, right? The heterogeneity in the MSME markets, the 3-year vintage criteria. So we are not throwing all of that away.
Oh, you're not throwing that away.
What we are doing is taking each of those, trying to backtest them as we create data to say, okay, what is relevant and what is not relevant, and hence keep on improving our credit models. Similarly, women run about 20% of Indian MSMEs, right? Their share in credit is 10% or less. Now, why does that happen? Because there are again certain, rules that have come into play over time, which inhibit access to credit for women entrepreneurs, right? Now, once you remove those and you start to rely on data algorithms, and there's appropriate governance around that, not to have gender as a parameter going in.
Correct.
We are seeing consistently 20%, 25% women borrowers getting access to credit.
That's huge from what I understand, 20-25%.
It is at least in line with the share of businesses that women run.
Correct.
Right? We have incidentally signed up for a global 2x challenge to take this above 30% in the next 3 years.
Okay.
Sorry,
Please
just
add.
come in.
Yeah.
So since we were talking about this in the MFI space, the women are 90% plus.
Yes.
So I just wanted to
Yes.
add that.
So I think there are definitive signs that are available that just building data-driven models, removing the biases that have existed for good reasons, but 5 years from now there's no reason for them to exist.
Yes.
Right? And I think a lot of this starts to become more relevant when you look at the micro and small end of the spectrum. Right? If you're looking at enterprise businesses, an underwriter will still walk in, form a relationship, take 6 months to build a view of that business, and that's fine, right? Because that is not where the problem of exclusion and cost is. But in the kind of customer segment we are addressing, our average ticket size would be about 6 lakh rupees of exposure, right? It is much more close to a retail lending business than it is to the enterprise lending business. And so we are applying a lot of those principles to solve for this.
Makes a lot of sense.
I
Thank
think
you.
just wanted to comment on something that Alok said, right? Credit models. I mean, the way credit models are run usually is you age a credit model, right? You push through enough data over a 3-year period, and then you take a call on the veracity of the credit model. Unfortunately, we sort of in a chicken and egg situation, right? All of us want to push 3 years of data, which has been supported through alternate credit or digital lending, and make credit decisions. But where do you get that data from? How do you start underwriting a model? And those are some of the challenges that require us to co-run both the traditional lending model along with the digital lending model, and then start to backtest some of the credit model lending.
I would say though that it's also a question of figuring out what your business is and investing behind it, right? I would love to be able to ship these bottles of water from tomorrow onwards, but unfortunately I have to invest in a factory if I have to do that. So for us, these data models are our factories that we want to invest behind so that we can start to ship bottles, right? And I agree with some of the comments earlier that, entities that are growing at 35% without breaking a sweat will have little motivation to do so. Entities like us were born with the sole purpose of serving this market, and hence, we have no choice.
Yeah, I have one last question, and I've been told we need to wrap up. But it's to you. I wanted to understand. So we talk a lot about data. Now, what is all this data? And what is really good quality data out there that we can actually use practically?
Yeah, there's a lot of voodoo about this alternate data, right? And it's been there for almost since the advent of social media.
A lot of acronyms also, GST, IN, AAA, and
absolutely,
so please
yeah. So
demystify.
I think just to put it simply, I think it's the ability to cut through the noise of excess data and only focus on highly correlated data. And you have to focus on literally 2 variables in credit. One, the data which can highly correlate in understanding the customer's intent and ability. Now let me explain you with an example. Same, let's take a restaurant business, right? What is a good alternative data that I can really leverage and take a much more sound and intelligent credit decision? If I tell you, I'm using a data around the customer reviews about the quality of the food the restaurant is serving, right? one alternate
that's
data.
fantastic, yeah.
Right? If I tell you about the purchasing power of the vicinity where this restaurant is located to determine whether this business will survive at the price point he's selling or not. I tell you, what about that quality of data where I tell you the promoter of an entity has some criminal or clean background or not. He has some political affiliations. Right?
So all this data is available in India today?
All of this data is available, and we are really driving this push, and we are pushing the envelope, and we are not only, this also about the adoption, right? And the adoption only comes through trust. Trust comes through backtesting and proving the empirically, right? So what we are also doing, we are going back to our clients and telling them, here is a predictive model, which is looking and forecasting the forward 12 months cash flows of an SME, not just looking at his past performance, but also adding up highly correlated alternate data, like example of an industry. Very industry specific, without bias though. There's a difference between industry specific and bias. A lot of credit models in India are built around human bias. Whether you like a customer or not during personal discussion or not. If you don't like it, customer is out. Industry bias, you have a portfolio bias. If my portfolio is working well, why should I experiment? So the alternate data is ultimately there to democratize the decisioning power. The ability to go much deeper, again going and reflecting on, is this through which I can determine the customer's intent and ability much better? And the best, and the delightfully, the answer is that AI today lends you that flexibility. There are so many advanced models where you can scrape through so many layers which a customer will never share and the bank will never be able to determine, that you can actually arrive at a highly correlated, highly, directly impacting the decisions that are likely to happen as well. So I think there is a lot of voodoo about it, but if you actually go deeper into it, there's a lot of meat, and you can build some very, very sound, not just low OPEX models, but also very sound underwriting models.
Right. Okay. No, thank you for that. I'd like to leave at least 5 minutes.
So I'll just put in one last.
Please.
I'll just give a big picture idea for about a minute. So we all see the GDP numbers which came out last week, right? 60% of that GDP is born and grown by the services industry. Manufacturing's share of wallet is only 20-25%. So obviously we are doing a lot in terms of Make in India, PLI, which is in the enterprise, if I can call it, play, right? But again, I come to the micro of the MSME. Unless a revolution there happens in terms of credit and in terms of growth, the entire share of wallet of manufacturing in the GDP will never come to 40-50%. So that was my only big picture point to leave with you.
Sure. So on that note, we are open to taking up one question. If anyone has, you may want to raise your hand. All right, sir, can you just quickly come ahead? We won't be able to pass on the mic to you there. Could our teammate just take one mic from our speaker and pass it to the gentleman out here? Can we just take one mic? Yeah. Very brief question.
Yes. So I understand that we spoke a lot about digital lending and using credit models.
Your name as well first.
Sorry. My name is Soham. Thanks for the lovely panel discussion. Wanted to understand the aspect that comes after a default. Say there is a default. How are you looking at recovery mechanisms, especially legal actions towards these MSMEs? Because many of these are unsecured loans. So what's the way forward there, and how are you looking at digitizing that aspect? I was curious about that.
Sure. Thank you. Would anyone like to take it up? Yeah, please.
Yeah, so, the tiering that we use is one, first invest aggressively in the digital payment collection, right? Which means mundane stuff of making sure reminders are going out, account monitoring is happening, your portfolio is split by risk, not just at the point of origination, but at any point in time. It is easy for customers to pay you through different digital mechanisms, right? So I think that is the first layer. We've seen about a 40% reduction in our first bounce rates as a result of investing in this chain, right? So, so this is not the tough collection, right? But it helps you reduce the instances that go forward. The second key layer is understanding what is the customer doing now, right? Which flows into the account monitoring scores, and that is what starts to determine the collection strategy that we apply. And that is then implemented through a combination of tele collections and field collections. On the collection automation front, we have largely relied on other companies that are building platforms rather than try to build our own workflow platform for collections. Right? But the rigor of that platform in terms of saying, okay, we can configure rules, we can figure out who the high-risk borrowers are, initiate skip redressal at the right time, initiate legal at the right time. So it's more investments in making sure the process works in a tight manner. And the cost of collections then starts to fall down. The second piece is, my firm belief is that if we are going to target the inclusion space, you will not land up with zero NPS, right? If you want to land up with zero NPS, then you can go and do what is being done today. And to that extent, I think it's important to build in risk into your model, price for that risk, and think of it as a portfolio-based decision, not as a per loan decision, right? So I think there is a beginning of the story here. Collections comes, at the fag end. Sorry.
There is an inherent, I would say, structural change also required. 90% of lending in India is all term loans. It's only 10% which is actually revolver credit. Revolving credit is where RBI asks you to do a monitoring. You have a relationship manager who will see your account. You can see the in and out. There's literally no touch, no maintenance of account on term loans. So I think that's where, again, technology is going to play a significant role. For a small ticket, you can't have a relationship manager. OpEx doesn't allow you. But you really need to have a very intelligent early warning signal. Can it give you insight, like 30 days, 60 days ahead? What are the signals that this customer is likely to become a 30-day DPT? And trust me, there are enough ways you can do it. It's just an intent that is required, right? And if it really addresses the elephant in the room, I think there's going to be much faster adoption of this as well. So again, I think going back to the way data can throw a lot of insight, you'll be amazed. Like, for example, if you start not paying provident fund of your employees 2 months, there's a high likelihood you will stop paying your EMI as well, right? Just to give you an example, right? But
Sure, thank you so much. Well, ladies and gentlemen, firstly, let's give a big round of applause to all our esteemed panelists. What a great session.